Welcome back to Stock Talks of Tuesdays, where today we shall explore the world of fixed income securities and the role they play in the financial markets. Mutual bonds are an important tool for investors seeking steady income and reliable returns, and understanding how they work is essential for anyone looking to build a diversified investment portfolio. In this podcast today, we'll delve into the intricacies of mutual funds and how they differ from other types of fixed income securities, such as corporate bonds and treasury bonds. We will discuss the risks and rewards of investing in mutual bonds and how to choose the right bond funds for your investment goals. So let's start by defining mutual bonds. Mutual bonds are a type of investment vehicle offered by mutual funds, which pool money from multiple investors with a shared investment objective. These funds, also known as bond funds, are managed by professional fund managers who aim to generate profits by investing in a diversified portfolio of bonds. The fund manager selects the bonds that the mutual fund will invest in, with the goal of buying undervalued bonds that will increase in value over time. As the bond value increases, the mutual fund can sell them at a profit, which is then distributed among the investors in the fund. Quite similar to the equity market, isn't it? Mutual bonds can be a relatively safe investment option because they are diversified across multiple bonds, which helps to reduce the risk of any single bond defaulting. Additionally, they are often actively managed by experienced fund managers. Mutual funds, corporate bonds, and treasury bonds are all types of investments, but they differ in terms of ownership, issuer, and interest payments. Mutual funds are owned by asset management companies that invest in various assets such as bonds, stocks, or cash equivalents. When an investor buys shares in a mutual fund, they're essentially buying a portion of the fund's holdings. The value of the mutual fund shares depends on the performance of the underlying assets. Corporate bonds are issued by companies to raise capital. When an investor buys a corporate bond, they are essentially lending money to the company for a specific period of time at a fixed interest rate. The interest payments are typically paid semi-annually and the principal is returned to the investor at maturity. Treasury bonds are issued by governments, specifically the US government, in the case of US Treasury bonds. These bonds are also known as a risk-free investment because they are backed by the full faith and credit of the government. Like corporate bonds, treasury bonds pay a fixed rate of interest through their term, and the principal is returned to the investor at maturity. Overall, mutual funds provide investors with exposure to a diversified portfolio of assets, while corporate and treasury bonds provide fixed income streams for investors seeking a lower level of risk. Now it's upon you to play your pieces on the financial board. You can either play a high-risk, high-reward game of investing in mutual funds, or rather you could play a low-risk, still high-reward in the long run by investing in treasury bonds. Thank you. That was Stock Talks of Tuesdays.